Welcome back to FCA Accountants Tuition Center YouTube channel. My name is Randolph Franklin, the lead tutor, the Chief Executive Officer, the pioneer of FCA Accountants Tuition Center. In today's video presentation, we are going to look at the non-profit-making organizations. But before we get started, I want just to encourage our viewers to ask questions relating to the question at hand in the chat box. All the questions that will be raised will be attended to depending on the availability of time. I also want to encourage our viewers to make comments in the chat box, or rather in the comment section. And all the comments will be useful in improving our lecture delivery. Today's topic is relevant for students doing CA 1.1 under ZICA, and the students that are studying degrees and diplomas in accountants. It is relevant for them. And also those students that are doing principles of accounts. This topic is relevant to them. Today, we are going to discuss the common terms that are used under non-profit-making organizations in comparison to profit-making organizations. I'm also going to address the examples of non-profit-making organizations. I'm also going to address the sources of income for non-profit-making organizations. And then we shall address the question at hand, which I'm sharing on the screen. Let me just get started by defining non-profit-making organizations. Non-profit-making organizations are those organizations which exist to provide a service to its members and not to make a profit. We have a number of examples, such as clubs. These clubs could be football club, could be a rugby club, table tennis club, squash club, and so forth and so on. We also have other examples such as churches. They are not for profit-making organizations. Government schools, government hospitals. Those are examples among others. Now, let me address the sources of income for clubs, because today we are specifically looking at the clubs. Sources of income for the clubs. We have subscriptions which members pay. We have gate takings. For example, football clubs, when they have a match, for you to go and watch the game, you need to pay. Those are gate takings. It's a major source of income. We have also donations received from well-wishers. We also have income from bar trading. Most clubs, they have a bar there. It is also a source of income. Now, I want to explain the common terms used under not-for-profit-making organizations. Not-for-profit-making organizations, they use different terms as compared to profit-making. So we have, this is profit-making. Profit-making organizations. Profit-making organizations. We have non-profit-making. Non-profit-making organizations. So we have one, profit-making organizations, they have capital. Not-for-profit-making organization, their capital is known as accumulated fund. So accumulated fund, that is the equivalent to capital. In number 2, we have profit-making organization, they will prepare capital. Sorry, they will prepare a cash book. Not capital, cash book. The cash book for not-for-profit-making organization, they have receipts and payments. Receipts and payments is equivalent to cash book. In number 3, profit-making organizations, they will make a profit for the year. Non-profit-making organization, this will be called surplus, since they are not there to make a profit. It is surplus, or it can also be referred to as excess income over expenditure. Excess income over expenditure. Number 4, a profit-making organization may incur a loss for the period. A loss is referred to as a deficit under non-profit-making organization, a deficit, or also excess expenditure over income. Excess expenditure over income. Excess expenditure over income. Number 5, profit-making organizations, they prepare statement of profit or loss. Abbreviation, statement of profit and loss. Not for profit-making organizations, they'll prepare income and expenditure. Six, not for profit-making organizations, they prepare statement of affairs. Statement of affairs. Profit-making organizations, they prepare statement of financial position. So basically, these are the terms which you need to understand when you are dealing with not-for-profit-making organizations. So now, let's look at subscriptions in detail. Subscriptions, we have subscriptions in arrears for the year. Subscriptions in arrears for the year. Subscriptions in arrears simply means members have enjoyed the services provided by not-for-profit-making organizations, but they have not yet paid their subscriptions. Therefore, subscriptions in arrears, these are income of the year. It must be included in the income of the year. That is subscriptions for the year plus subscriptions in arrears. And in the statement of affairs, subscriptions in arrears for the year, they are reported under current assets because it's an asset, current assets. Then we have subscriptions in arrears for the previous year. subscriptions in arrears for previous year. Subscriptions in arrears for previous year now received in the current year, they are not part of the income for the current year. And therefore, subscriptions in arrears for previous year, you must deduct them. Deduct from the total subscriptions received. So that is one aspect that you need to understand. Then I come to subscriptions in advance for the year. Subscriptions in advance for the year. Subscriptions in advance for the year. These are amounts received now for the coming year. So subscriptions in advance for the year is not part of the income for the current year. Therefore, you need to deduct subscriptions in advance for the year from the total subscriptions received. So not income for the year. And in the statement of affairs, it must be shown under current liability because we have received in advance. Current liability. Subscriptions in advance for the current year is not income for this year, and therefore you must deduct from the total subs received and recognize the amount in the statement of affairs under current liabilities. Subscriptions in advance for the previous year. Subscriptions in advance from the previous year. Okay. Subscriptions paid in advance from the previous year. This amount is meant for the current year, and it is income for the current year. And it's not going to be shown in the statement of affairs because it was already recognized in the previous year. In this year, it is part of the subscription, part of the income, and therefore it must be added to the subscriptions for the current year. So those are the two issues. Is that okay now? So now we can look at the question at hand. The question at hand, we have a question here. Buffalo Football Club had the following assets and liabilities on 1 January 2021. We have the buildings, cash in hand, subscriptions in arrears. So here, subscriptions in arrears at the beginning, it is an asset. Subscriptions in advance at the beginning, it's a liability. During the following transactions occurred. Subscriptions for the year to 31st December 2021, 90. Subscription from previous year, 19. Subscriptions in advance, 15. Staff salary, general expenses required. Calculate the accumulated fund. We already know the accumulated fund is equivalent to capital. Capital at the beginning of the year is equal to total assets less total liabilities. So we can find out that requirement number 1, accumulated fund, abbreviation there. We have the assets. The assets here we have the buildings, The buildings there, we have 520,000. Then we have cash at bank. Cash, that is 13,600. Then you have subs in arrears. It's an asset. Subs in arrears is an asset to 5. Total 536. 100. Then we have the liabilities. The liabilities here we have subs in advance. Subs in advance, that's the liability, 700. The accumulated fund at 1 January 2021 is equal to 535,400. So we have calculated the accumulated fund. Now we go to the subscription account. The subscription account here will be, can create some space. Subscription account. Subscriptions account. This is debit side. The credit side. We have the opening balance. This is the opening balance, which is an asset. It must be debited. Balance brought down 2,500. It's an asset. And then we have a liability, opening balance as a liability, balance brought down, liabilities are credited. This is at the beginning, or this is 1 January. And then now we have the bank. The bank, we received this plus that plus that. This is what we received, the bank. At the bank, it will be debited. In the subscriptions account, it will be credited. Bank, the total there is 93,400. At the current year, subscriptions in advance for 2020, it's this. This is a liability. So a liability at the end, this will be balanced, carried down, that is 1.5, so that when you bring it down, it will be on the credit side because it's a liability. $1.5. Then the balancing figure here is what will go to the income and expenditure. Total, there 94,100. 94,100, which is brought on the other side, 94,100. Then the balancing figure there is 90. 90,100 is what we going to take to the income and expenditure. So this is how the subscription account would look like. And now we can do the last part, prepare receipts and payments, which is equivalent to the cash book. So we have receipts and payments. Receipts and payments account. We have the opening balance, which is 13,600. This is debit because it's favorable. If there was an overdraft, it was going to be credit. The balance brought down 13,600. And then subscriptions. Subscriptions received 93,400. That is when you add up those. Then we have staff salaries. Staff salaries or wages. That is 25,000. Then we have general expenses. General expenses, we have 54. Total 107,000. You transfer on the other side, 107,000. The closing balance, which is favorable, which is 28,000, which is brought down here. So we have addressed the question in full. For today, we can stop here. But on behalf of FCO Accountants Tuition Center, I want to thank you all for supporting us, both the new subscribers and the old subscribers. You are doing a recommendable job for the support that you are giving us. May the Almighty God, Jehovah, bless you beyond measure. Thank you.